Mortgage rates just hit their lowest point in 3 years. On Friday, January the 9th, rates briefly touched 5.99%. That is a massive drop from where we were just a year ago when rates were hovering above 7%. If you missed that exact moment, don't worry. Trying to time the market for the perfect rate is a losing strategy. The real opportunity is understanding what's driving these moves and having a clear strategy for when the math makes sense for your specific situation. We're going to break down exactly what happened, why it matters, and what you need to focus on as a buyer or seller in this market. On January the 8th, President Trump issued a directive ordering Fannie Mae and Freddie Mac to buy $200 billion in mortgage-backed securities. That announcement alone sent shockwaves through the mortgage market. By Friday morning, January the 9th, the average 30-year fixed rate briefly flashed down 22 basis points to 5.99%. That is not a normal move. Rates typically shift by hundredths of a percent per day, not entire quarters of a point overnight. But here's the reality check. That 5.99% number was a morning snapshot. By that same Friday afternoon, mortgage-backed securities were experiencing significant volatility as traders scrambled to figure out what this policy shift actually meant. Lenders started adjusting rates back up within hours. By Tuesday, January the 14th, rates had stabilized around 6.07%. The 5.99% window was not a sustained rate drop. It was a flash event that lasted hours, not days. Then, the December CPI report came out on Tuesday. Inflation is holding steady and not accelerating. That's good news. It kept rates from climbing higher. But inflation isn't falling fast enough to spark a major rate drop on its own. The bond market absorbed the news and basically held steady. That tells you everything you need to know about where we are right now. Here's what matters to you. If you bought a home in the last 2 years or so when rates were 7% or higher, you might want to have a conversation with your lender. Even though that Friday morning flash to 5.99% didn't hold, rates around 6.07% are still significantly better than where they were 6 months or a year ago. A rate and term refinance is priced the same as a purchase mortgage. On a $400,000 loan, dropping from 7% to 6.07% still saves you roughly $250 per month. That's $3,000 a year, and over the life of the loan, that's nearly $90,000 in interest savings. Get pre-approved, know your numbers, understand your break-even point. When the savings justify the cost of refinancing, that is your signal to move. If you're a veteran or an FHA buyer, your rates are actually better than the conventional headline numbers. While conventional loans briefly hit 5.99% on Friday and are now back to around 6.07%, VA and FHA rates dropped into the mid-5s during that window. We're talking 5.4 to 5.67, and they're still running lower than conventional rates today. That's a meaningful difference. On a $400,000 loan, the gap between 6.07 and 5.5 is roughly $150 a month. If you use VA or FHA financing, you need to know that your rate is going to be consistently lower than that of conventional borrowers. Now, the rate is not the only thing to consider with different types of financing, and that's a different topic for a different video. So why does buying mortgage bonds push rates down? Think of Fannie and Freddie as a giant vacuum cleaner sucking up debt from lenders. When they buy those bonds, lenders suddenly have cash freed up to lend to homebuyers. More money available to lend means lower interest rates. Simple supply and demand. When demand for bonds goes up, yields drop, and mortgage rates fall right along with them. Now here's what's interesting. This isn't the Federal Reserve stepping in. The Fed has been sitting on the sidelines since their last rate cut in 2025. They're pausing because inflation is still a concern, and the latest jobs report showed the economy adding only 50,000 jobs in December, while unemployment ticked down to 4.4%. That's not enough to justify another Fed cut anytime soon. So instead of waiting for the Fed, the administration went directly through the government-sponsored enterprises, Fannie and Freddie. Let's talk about what this actually means for your wallet. The real impact is purchasing power. Every quarter point drop in mortgage rates adds roughly $10,000 to your buying capacity. That means if you were approved for a $400,000 loan at 6.5%, you can now afford a $420,000 home at 5.99%. And that's with the same monthly payment. That's a bigger home, a better neighborhood, or more room in your budget for other expenses. For first-time buyers, this is one of the best entry points we've seen in years. Wage growth is finally outpacing home price growth. That hasn't been true for most of the last 5 years. Combined with lower rates, affordability is moving in the right direction. If you've been saving for a down payment and you're waiting for the right moment, now might be a really good time to act. Real estate is hyper-local. What's happening in one neighborhood can be completely different from what's happening 2 miles away. We have micro markets where some homes are selling very quickly with multiple offers over asking. Others are having a tougher time. The latest data proves this point. While the national average shows sales are up 5.1% in December, the South and the West saw jumps of nearly 7%, while the Midwest actually declined by 2%. Same country, same month, completely different outcomes. That's why working with someone who understands your specific market is critical. The national headlines give you the big picture, but your local market determines your actual opportunity. For move-up buyers, the challenge is different. Inventory has been tight for years because so many homeowners are sitting on low rates and they don't want to give those rates up. It's been limiting your options. But if you bought your current home in 2018 or 2019 when rates were in the 5 to 6% range, this is your moment. You can now move laterally without taking a massive rate hit. That's a big deal for people who feel stuck in their homes that no longer fit their needs. Cash out refinances are typically about a quarter point higher than rate and term refis, but they're still accessible. If you need to pull equity out of your home for renovations, debt consolidation, or investment purposes, this could be a good time to do it. One more thing to consider, rate buy-down. Lenders can potentially push your rate even lower if you're willing to pay points up front. If the market rate is 5.99%, paying 1 point might get you down to 5.5%. Maybe lower, it just depends on your credit and loan structure. That's a conversation worth having with your lender, especially if you plan to stay in the home long term. Now let's talk about sellers. If you've been holding off on listing your home because you don't want to give up your 3 or 4% mortgage rate, you're not alone. The question is, does 5.99% change that equation? For most sellers, the answer is still no. Here's the math. The average outstanding mortgage rate in the US is about 4.4%. That means if you sell and buy again, you're trading a 4.4% rate for a 5.99% rate. It could be worth it for some people, for others it's not. Picture this. You're a growing family in a 2-bedroom starter home. You need more space. Maybe a third kid's on the way. Or maybe you're working from home and you need an office. You bought at 3.5% years ago. Now you're looking at 5.99% on a bigger mortgage. Your monthly payment jumps by $500 or more. That's why so many families feel stuck in homes that no longer fit their needs. If you bought your home between 2018 and 2019 when rates were in the 5% to 6% range, this is your unlock moment. You can now sell your current home and you can buy your next one without taking a major hit on interest rate. You're moving laterally, or even maybe slightly better if rates continue to drop. That's a big deal for people who've outgrown their current home but feel stuck because of their rate. The real unlock happens if rates drop into the low 5s or high 4s. That is when we would start to see a very meaningful movement from sellers who've been sitting on 4 to 5% rates. If rates hit 4.99%, the psychological barrier suddenly breaks. You're trading a 4.5% rate for a 4.99% rate instead of a 6.5% rate. That's manageable for a lot of people, especially if they need more space, they want to relocate for work, or they're looking to downsize. The other factor here is the spring selling season. Last year's spring market was frozen. Inventory was tight, buyers were hesitant, and transaction volume was down. This year is already shaping up to be better. Lower rates mean more buyer demand, and more buyer demand means homes are selling faster and often at higher prices. If you've been thinking about selling, this could be a good time to list. The risk is that if rates bounce too high above 6%, buyer demand will likely cool off pretty fast. So what happens next? Market analysts are watching for a potential stair-step approach to bond purchases. The initial $200 billion directive covers roughly 1 to 2 months of typical mortgage origination volume. If additional purchases follow, some analysts project that rates could drop another 25 to 50 basis points. That would put us into the mid 5% range. That timeline remains speculative though, and it depends on how the bond buying program is executed and how the market responds. There's a lot of unknowns there. But here's what Friday's flash event taught us. Rates can move quickly in response to policy announcements. The December CPI report showed inflation is holding steady, which is good, but it's not falling fast enough to give the bond market confidence for a sustained rally. That means that rates are likely to stay in the 6 to 6.5% range unless we see either a major economic shift or another round of government bond buying. Friday's 5.99% flash event proved something critical. Trying to time the market is not a winning strategy. Rates are at 6.07% as of this week, still well below where they were a year ago when rates were over 7%. The real opportunity is having a clear plan and acting when the math makes sense for your situation, not chasing the lowest possible rate. If you're thinking about buying, selling, or refinancing, now's the time to get your strategy in place. Get pre-approved, know your numbers, understand your break-even point. When the savings justify the move or your life circumstances require it, that's when you act. If you're in Georgia or Metro Atlanta, reach out to me for a custom strategy session. There's a link down below in the description. Just fill out a simple form and we'll get in touch. If you got value from this, please subscribe to the channel and like the video. I'll see you in the next one.